Best stocks to invest in 2022. Overall, 2021 was an excellent year to invest. The indices did exceptionally well, with the S&P 500 up 26% year to date. However, it was a difficult year for growth investing, with the Informal Growth Index ARK Innovation down 22% year to date. See today the top stocks for 2022. 1. Microsoft. As one of only two companies with a higher credit rating than the US government and the only tech giant not facing noteworthy regulatory scrutiny, it's difficult to find flaws with this highly profitable and diversified firm. Microsoft will be able to maintain its position as a crucial utility in the digital economy for years to come thanks to its Windows operating system, Azure Cloud, and cybersecurity solutions. Analysts project that Azure will carry Microsoft to 15% earnings growth next year, which is quite formidable when combined with Microsoft's generous shareholder returns. The company isn't cheap with a P of 37, but I believe this is a case where it's worth paying extra for quality. Google. Continuing with the cloud computing theme, Google Cloud has become one of the three leading hyperscale cloud providers. Like Microsoft, this is a shareholder-friendly company that's still growing quickly, with analysts projecting 17% revenue growth next year. Cyclical advertising still forms the majority of Google's revenue. But with strong economic growth expected in 2022, this may benefit investors next year. Google looks reasonably valued, with a PE of 28 and a peg below 1. 3. Amazon. No cloud or e-commerce portfolio would be complete without Amazon, the current market leader in both categories. I'm concerned about Amazon's recent leadership transition, the lack of buybacks in the face of slowing growth, and growing competition across the company's product lines. However, given how quickly the underlying industries are likely to grow, I believe analysts' prediction of 29% earnings growth in 2022 is a credible aim. And, as Amazon has done in the past, maintaining that kind of growth should continue to result in great returns. 4. Although TSMC does not directly fall into the portfolio's two key themes, the company's truly unique semiconductor manufacturing technology gives it a large moat and places it at the core of broader digitalization trends such as cloud computing. Apple, as well as data center chip designers Nvidia and AMD, are among TSMC's most important clients. However, unlike many of its customers, TSMC appears to be fairly valued, with a PE of 30 and forecast growth of 19% in 2022. Part of the discount is due to regional risk in Taiwan, but I don't expect this risk to have a significant impact in 2022. 5. ASML Holding. Like TSMC, ASML is a wide moat corporation with a focus on semiconductors, putting it at the forefront of digitalization. ASML is the only business capable of creating the equipment required for advanced semiconductor manufacturing, and this will remain true in 2022 and for many years to come. With a PE of 53, ASML today appears to be a bit pricey, but it's also expected to boost earnings by 23% next year. I'm sticking with ASML, which was one of my greatest winners this year, but more value-oriented investors might prefer Lam Research. 6. CrowdStrike. We've arrived at the riskier half of the portfolio, CrowdStrike. Although there are numerous SaaS companies to pick from, CrowdStrike is at the top of my list because it benefits from cloud computing in three ways. It scales quickly, like most SaaS, benefits from rising cybersecurity needs as a result of distributed computing, and is displacing traditional providers that haven't gone to the cloud. It's also a high-quality business, having a Rule of 40 score of 54. Because a single breach can have a tremendous impact, I'm less confident in CrowdStrike's tail in 2022, but with analysts forecasting a whopping 58% profits increase next year, I believe the reward is well worth the risk. Seven. Okta. I tried to pick at least 2 firms for each sub-theme, and Okta is the second. Third, if you consider Microsoft, stock focused on cloud computing and cybersecurity convergence. Despite having much of the same growth drivers as CrowdStrike, the company hasn't delivered on the same degree of quality, scoring only 12 on the Rule of 40 despite forecasting considerably lower revenue growth of 37%. Despite this, I believe Okta's focus on identity management, a field with strong network effects and learning curves, provides it with greater long-term stability than most cybersecurity firms. Fortinet, Nasdaq FTNT, which performs better on the Rule of 40 and offers buybacks but is expected to grow more slowly, is a good option for investors looking for a more profitable company right now. Eight. Sea Limited. When it comes to e-commerce, Sea Limited's ShopPay platform has earned it the distinction of Amazon of Southeast Asia. E-commerce in emerging nations is especially interesting because it only has an 11% penetration rate, compared to 18.7% in the United States. Southeast Asia's youthful population is also a positive factor, contributing to 5.7% GDP growth until 2024, compared to a more normal 2% in established countries. Finally, with only 18% of individuals in low-income economies owning a debit card, the convergence of e-commerce and fintech offers a major opportunity. Sea has a thriving gaming section that it utilizes to fund and advertise its other branches. This up-and-coming behemoth is anticipated to double its sales next year. Nine. Mercado Libre. In 2021, all of the above stated companies had positive returns, excluding Okta by a whisker. We'll finish up the portfolio with a pair of fallen angels, starting with Mercado Libre, which is South America's Amazon. Despite the lack of a gaming sector, the company is comparable to Sea in that it profits from serving an emerging market with low e-commerce and banking penetration. While Mercado Libre competes with Sea, it is arguably more dominant in its local region. The stock has plummeted to an all-time low value due to macro concerns, but I foresee a return in 2022. Analysts seem to agree, predicting a 36% increase in revenue and even faster earnings growth next year. 10. Alibaba. Owning Alibaba has been a very frustrating year, as the otherwise excellent company has been subjected to continual sabotage by both the CCP and the US government. This has resulted in a number of earnings misses, as well as concerns about increased competition and delisting. Despite its all-time low valuation and recent troubles, Alibaba fits well into the portfolio's e-commerce and cloud computing themes. It is China's leader in both. In China, cloud computing is still in its infancy, and Alibaba has a greater opportunity in fintech than its developed world rivals, which makes me optimistic about the company's future. Investors who want to avoid the geographical risk of Alibaba, or Mercado Libre, should instead invest in Shopify, NYSE, Shop, which is pioneering e-commerce and fintech in developed economies. Thanks for watching. Subscribe to our channel.